On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi team, hope everyone is well. Let's take a look back at last week, then let's turn our attention to what's coming up in the week ahead. It was a mixed bag for global share markets. Many did take a bit of a breather after strong gains earlier during the month of May. The S&P 500 in the US was flat, virtually unchanged over the week, but there were some ups and downs along the way. We did see a very good result from Nvidia, and that company's share price rallied quite strongly. If you want to know more about that, touch base with your Craig's advisor and we can send you a copy of the report that our analysts have written on Nvidia. But there are still some lingering concerns about inflation. It's not falling quite as quickly as we would like, and the Federal Reserve in the US might not start cutting interest rates as quickly as people have been hoping for. So still is a little bit of caution out there. European shares slipped 0.4%, Japan was down 0.1%, and emerging markets were down 1.5%. Remember, emerging markets had a good week the week before that, so that's maybe why they've fallen a little harder than most. It was quite an eventful week in the United Kingdom. In the UK, we saw the FTSE 100 fall 1.2% for the week, and there was some important news on the inflation front, good and bad. The annual UK inflation rate fell to 2.3% in April, so the bad news is that's a little bit higher than expected. Markets were looking for 2.1, so came in a little bit hotter than people were hoping for, but still 2.3 is great progress from what we've seen in recent times. In the UK, inflation was north of 10% at one point, and at 2.3%, that's still the lowest in 3 years. We also saw the British Prime Minister surprise markets by announcing that there will be a snap general election on the 4th of July in the UK, even though the government has until January next year to hold one. Nobody expected them to announce one quite as quickly as that. People thought they might do something later in the year because they've got all the time until January, and we're sitting here in May, so it is much earlier than people were expecting. In Australia, the ASX 200 was down 1.1%, while the local NZX 50 here in New Zealand was actually one of the better performers. We rose 0.7% for the week, which is better than all of those other markets that I've mentioned. Interest rates in the US up slightly. We saw the 10-year US Treasury yield finish the week at 4.5%, and locally interest rates moved higher too. And the moves were a bit bigger here in New Zealand after some tough talk from the Reserve Bank, which we'll discuss shortly. But our 5-year swap rate increased 19 basis points to 4.6%. So that's the highest we've seen in about 3 weeks. It did rebound after having fallen the best part of the last month or so. Right, let's look back at some of last week's key releases and developments, and we won't run through everything. I will just pick out some of the things that I thought were really interesting and are worth talking about. And top of the list is the Reserve Bank monetary policy statement. So, as expected, the Reserve Bank left the official cash rate, the OCR, unchanged at 5.5% last week. So that's the highest we've seen since 2008, 16 years ago, and that's where the OCR has been since May last year. So for the last 12 months, we've had an OCR of 5.5%. You've got to go back a whole year to find the last time that the Reserve Bank increased it. We all expected that, so what we were watching for were the new forecasts and the commentary that we would see and hear. And the forecasts came in the accompanying monetary policy statement, and in that, the Reserve Bank increased the peak of its forecast OCR track ever so slightly, from 5.6% in February to 5.65% in May, so it's only gone up marginally. Really interestingly, the summary record of meeting, which is essentially the minutes, that also noted that they did talk about should they hike the OCR further. Now, I imagine that was quite a brief discussion because they elected to leave the OCR on hold, and that seems to very much be the consensus view. But interesting that they did discuss whether they should be hiking or not. Now, after peaking in the December 2024 quarter, this is for that OCR track, that forecast track, so it peaks in the final quarter of this year, 5.65%. It does then start to decline, but it doesn't fall below its current level, 5.5%, until the third quarter of 2025. So you can take that a couple of ways. I suppose you can say on the one hand, well, they've got the OCR peaking this year and then it starts to come down. That's not terribly far away, but then you can also say, well, it doesn't actually get any lower than it is today until the third quarter of next year, which is 6 months later than we saw in the February MPS, and there's quite a lot of time between now and the third quarter of next year. We're obviously only in the second quarter of this year. We don't want to get too hung up on these forecasts. It is like any model, it's useful, but it will be far from correct or accurate. So you do want to some degree, take these sorts of things with a grain of salt. But I think what it does tell you is that the Reserve Bank doesn't see any need to start easing monetary policy over the coming months. They very much do see that as a 2025 story. Now, that could change. The market disagrees. Financial markets still see November as the most likely timing for a cut to the OCR, and that is not too far away. That's only 6 months away. So financial markets sort of don't believe the Reserve Bank. They don't believe they will wait until next year. They believe that the Reserve Bank will have to take some action this year. But look, time will tell. 6 months can be a long time in financial markets when you're in such an interesting position. Looking at some of their other forecasts, they did reduce their economic growth forecasts over this year and the next. They left their unemployment forecasts unchanged. So they still have unemployment rising to 5.1% next year. At the moment, it's 4.3%. And that's quite a big rise. 0.8% is quite a lot of people that will be without jobs. So that is something that we need to keep a close eye on, because that will have implications for spending and for people's well-being, obviously, and for earnings growth for companies and for economic conditions generally. The labour market is a really crucial piece of the puzzle. The Reserve Bank did increase their inflation forecast, so in response to that stickier non-tradables domestic inflation, they now see the headline inflation rate finishing this year at 2.9%. Before, they expected it to finish the year at 2.5%. So I guess the good news is they still see inflation falling to within that 1 to 3% target band that they have by the end of the year, but it's right at the top of that target band, 2.9%, whereas before it was at 2.5%, and that's getting closer to where they ideally would like it to be, around that 2% level. So 2.9% by the end of this year, and then next year at 2.2%, which is a little bit higher than they had last time, but again, at least it is falling. And that's all because of that domestic inflation picture. Despite wage growth expectations having come down, they actually reduced their wage growth forecast. So on the back of that, they expect house prices to increase by a more subdued level, 2.3% for this calendar year, which isn't a whole lot, and they expect those rate cuts to be a 2025 story. So the market reaction was relatively muted. You did see interest rates tick up a little bit, and you saw markets push out those expectations for when you will get an OCR cut. However, like I said a few minutes ago, financial markets still see the first OCR cut coming this year. November is seen as the most likely timing, and that's priced in at the moment to the tune of 91%. So markets are very confident that we will see an OCR cut this side of Christmas. We will just have to keep an eye on developments in the economy and on the inflation front. So that was the Reserve Bank last week. If you want to listen to the press conference, just look on the Reserve Bank's YouTube channel. They do a press conference where there's a room full of journalists, and those journalists asked some quite pointed questions, some very good questions, and you will learn a lot by watching that sort of 30-minute press conference with Governor Orr and some of his colleagues. And if you want to know more about sort of what the Reserve Bank is thinking and why they're doing what they're doing and why are they not reducing interest rates when it's quite tough out there for people, and all of the sort of aspects of their decision making, it's actually it's worth a watch. So take a look on their YouTube channel. I always make sure that I watch those. I usually watch them live, then I sort of watch them, once or twice again, because then I pick up a couple of extra bits and pieces. So would definitely recommend that if you got the time and the interest. Right, we also had dairy price figures out last week. We got the latest global dairy trade auction results, and they were good. Headline prices were up 3.3%, so that's the fourth auction in a row where they've gone up, and that's actually the strongest we've seen since early February, so that was pleasing. The GDT index is now up about 11.5% this calendar year, and it's at its highest level since October 2022. So the backdrop is pretty good as we look ahead to this week. And this week we should get Fonterra's opening forecast payout for the 2024-2025 season. For the season that's just about to end, the expectation is $7.80. That's the midpoint of Fonterra's range, so it could be a little higher, could be a little lower, but that's their best guess sort of midpoint. And on Wednesday, I think, when we get the business update from Fonterra, that should include a forecast for the next season. It should be comfortably in the eights, which would be very pleasing for the agricultural sector and for all of those communities up and down the country that rely on a strong dairy sector for economic activity. So that is good news. Some more good news came late last week, and this was the flash PMIs, which are activity indicators. These were for the month of May, and we got them for many of the major economies. We got them for the US, for Europe, for the UK, for Japan, and for Australia. And they were good across the board in terms of economic activity. We saw the US composite PMI rise to 54.4, so 50 is your break even, so you want to be higher than that, and 54.4 is quite strong. That's well above that break even level, and it's actually the highest we've seen in just over 2 years, so that was pleasing. Similar story for Japan and Europe, comfortably above break even, the highest in 9 months for Japan, the highest in 12 months in the case of Europe, and in Australia and the UK they were also expansionary, above 50. So good news there. Most of the world's major economies are still growing, which is positive. The inflation figures and indicators, good and bad. In the US, a bit less encouraging. Now, we know that in the US, inflation has been quite sticky. The Fed is having trouble getting it below current levels, and sort of that last mile of inflation, that in some ways that is the price you pay for an economy that is still performing very, very well. But these told us that US input prices have continued to rise during May, and manufacturers in particular have reported a particularly steep rise amid reports of higher supplier prices. So they're trying to pass those higher costs onto consumers in the form of higher selling prices, and we've seen the rate of increase there accelerate compared to the previous month. So good and bad in these PMI releases, these surveys. However, in Europe, things looked a little bit better. Inflation indicators definitely looked softer, and the pace of increase in both input and output prices across the services sector softened compared to April. So I think we're still on track for that ECB, that European Central Bank rate cut in June. That meeting takes place on the 6th of June, which is not far away now, just a couple of weeks away. And my guess today would be that you still will see the ECB cut interest rates. So that will be an important milestone. It will be the first of the big global central banks that does cut interest rates. The Federal Reserve in the US, as well as the Bank of England, and certainly here in New Zealand and across the Tasman, they will take a little bit more time, but Europe will be the first cab off the rank, so to speak. Anyway, turning to the week ahead, there is quite a bit going on. Where should we start? Inflation will be in the spotlight again. We will get inflation indicators across many of the major regions this week. We'll have PCE inflation in the US. We'll also have preliminary measures in Europe and the Tokyo CPI in Japan. So that PCE inflation report in the US will be the key one. And this will cover the month of April, and it is due out, I think, on Friday night in the US. Yeah, it always comes out on a Friday, so we won't get it until Saturday. So you can get up on Saturday morning, have your coffee, and before the kids are off to football or whatever sport they play, netball, then you can read the personal consumption expenditures report for April, as I will do, and I'll really enjoy that. This is the Federal Reserve's preferred inflation measure, so it will be closely watched, and especially after we've seen some ups and downs on the inflation front over the last few months. The regular CPI last time, a month ago, for the same period, for April, came out a little below expectations, so that was really pleasing because we had 3 months of hotter than expected, so to get 1 month where it was slightly cooler than expected, that was good news. So we'll be watching this one to see if it's a similar story. And markets are expecting headline PCE inflation to have risen 0.3% in April. That would see the annual PCE inflation rate unchanged at 2.7%, which isn't too bad. At least it's in the twos. Core inflation expected to rise 0.2% for the month and 2.8% on an annual basis. So again, at least you're in the twos. So 2.7 headline, 2.8 for the core at an annual level, and both of those figures for April would be unchanged from March if they do indeed come in at those levels. So this will be important because, as is the case here in New Zealand, investors are all talking about when will we see pricing pressures moderate to a point where the central bank can start easing monetary policy. And like I said, financial markets think the Reserve Bank of New Zealand will move in November. US markets have actually moved in a similar direction, and financial markets in the US now see November as the most likely time for the Federal Reserve to cut interest rates. There's still an outside chance of a move in September. Well, it's more than an outside chance, it's 50-50 to be honest, but the odds rise to 80% by November. So that is where I guess financial markets in their wisdom see the most likelihood. So you're just seeing these rate cut expectations sort of pushed out further and further. So that will be the highlight of the global calendar, and it won't come out until overnight on Friday here in New Zealand. We'll also get the Federal Reserve's beige book. That's midweek, and that's sort of take the pulse of the US economy. Chinese official PMIs for May are out on Friday afternoon. Those PMIs that I just talked about that were good in most of the major regions, we get them a week early. The Chinese ones come out a little bit later, so that'll be Friday afternoon, 1:30 I think New Zealand time. And also bear in mind that it will be a holiday shortened week in the US. There's Memorial Day on Monday, which means the US markets will be closed. Other markets around the world still open, but the US is the biggest market by far, and the US often sets the tone for other share markets and bond markets around the world. So it's just much quieter, and other markets can sometimes find them a little bit more directionless if you don't have that big behemoth open. So the US will be closed on Monday and it will reopen on Tuesday. Locally, plenty going on, and Budget 2024 will take centre stage on Thursday afternoon. So that will be the key event for us. Nicola Willis, Minister of Finance, will deliver the budget on Thursday. Usually comes out shortly after 2 p.m, and then there will be coverage on all the TV channels and through the other media, so plenty of information. And I guess this time around, tax cuts are expected to be the centrepiece of this budget after National included that as a major part of its election campaign last year. However, I wouldn't get my hopes up. They could be a little bit underwhelming compared to the tax reliefs that we've seen from past national governments. You think back to other national governments that have campaigned on and delivered tax cuts. It's probably not going to be like that. You're really only talking about some changes to the brackets and the thresholds. So yes, it's a tax cut, but it's not going to be significant. And they're really just moving those brackets out, which they should do, because inflation has been chipping away at our purchasing power over the years. So I think we're due to sort of have those brackets moved anyway, but it's unlikely to be a particularly generous affair. Willis has said earlier in the piece that this won't be a big spending budget, which I guess is something we could have all guessed, because of the state of the books and the state of the economy and all the challenges that the new government is facing in terms of dealing with some of these issues. She has noted that we can expect a big funding boost for the health system and targeted new investment in other frontline services such as education, such as police, and we've seen a few announcements on the way through. So this will be interesting. It'll be the first real costings as well that we'll see of the government's policy plans. So the first time that we can see what the Treasury thinks in terms of how much things will cost and how they will potentially impact the outlook. But I don't envy the politicians, to be honest, with a weak outlook for growth, with softer tax revenues, lots of costs, an infrastructure deficit. It's really a difficult time, and they're going to have to find the right way to sell those tax cuts, because there will be a lot of pressure on them to prove to everyone that they're not borrowing to fund those tax cuts. Because I think, even though many of us believe we can spend our money, it is our money, always remember that tax money, it's not the government's money, it's our money that they've taken off us. I think we can all agree that we are better at spending our own money than the government is in many cases, and we do want to see more efficiencies, and we want to see a more frugal approach than what we've seen in recent years. However, at the same time, I think we're all very realistic that if there are places where money needs to be spent, and given our existing high debt levels, we don't really, it won't go down well with the electorate if the rhetoric post-budget is the government is borrowing to fund tax cuts. So this will be an interesting one on Thursday afternoon. I think markets will be interested in the borrowing program, where debt levels are headed, how long we might need to wait for a surplus. And the Reserve Bank will also be interested. A feature of their commentary last week was that everything in their numbers is only the government's policies that have already been announced, from the mini budget and so forth. So anything new or anything that's not in the official figures, they haven't accounted it for yet. So we want to see, how does the Reserve Bank see some of the cost cuts that might come through? How does the Reserve Bank view the tax relief, and which one is sort of has a bigger impact than the other? Because the cost cuts that you might see are a negative for growth, and that presumably helps the inflation picture because it reduces demand. But then any tax relief, that can be mildly inflationary, because that could add to demand. So one might sort of offset the other, and it might just be a matter of how the Reserve Bank interprets it. So we'll be watching to see what they think as well, and we'll hear from them in due course. So that's the big one for us here in New Zealand, but it's not the only thing. We have also got an ANZ Business Outlook survey for May, which is due a day before the budget at 1 o'clock on Wednesday. And in recent times, the last few months, we have seen business confidence fall. I think the headline measure has declined now for 3 consecutive months, and it's the lowest since September last year. So times are tough out there, and businesses are feeling the pinch. We'll be watching to see whether things have slipped further. We'll be watching some of those inflation measures, because even though they have come down, you've still got a big proportion of firms that are expecting their costs to go up over the next few months, and you've got a slightly smaller but still too high proportion that are telling us that they will, or telling ANZ, I should say, that they expect to raise prices. And those things need to move for the Reserve Bank to have confidence that future inflation is coming down to the degree that they would like. The individual sectors will be interesting to watch as well. I think last time retail and construction became more pessimistic compared to the previous month, but agriculture, services, manufacturing fell more modestly. So we'll be looking for all of those things to gauge the mood of how New Zealand businesses are feeling. There's also plenty happening on the corporate front too, because you've got the reporting season that's heating up on the NZX. So we'll have lots of companies that are announcing results, and some of them are some pretty big ones. Ryman Healthcare and Kiwi Property on Monday. Tuesday, Arvida, Goodman Property, Serko. Wednesday, Fish and Paykel Healthcare, Mainfreight, Raycon, Sanford. And you've obviously got that Fonterra Q3 update as well on Wednesday, which will be interesting because it will hopefully mean we get that opening forecast for the milk payout. So a few heavyweights in there, Ryman on Monday and Fisher & Paykel Healthcare and Mainfreight both on Wednesday. So all of these businesses will be interesting to watch. Mainfreight, you always learn a lot in terms of the economic backdrop and the outlook there, and they are very much a global business these days. So you don't just learn about New Zealand from their comments, you learn about Australia, you learn about Europe, Asia, and North America as well. So a really interesting week on the corporate front. Internationally, there are a couple of results to watch. We had Nvidia last week. No one's as big as Nvidia, no one's as high profile at the moment, but we will hear from Salesforce on Wednesday in the US, and then on Thursday, Costco and Dollar General. So still a couple of companies to keep an eye out for. I know Salesforce and Costco in particular are two businesses that many New Zealand investors have interests in and own shares in. All right, so there's actually quite a lot going on, isn't there? The budget will be interesting, US PCE inflation, and I'll be very interested in a couple of those local results. So enjoy your week, everybody. Hope that is useful, and we'll talk again soon.
For more insights, visit craigsip.com.